Before you buy a stock, you need to actually understand what you're buying, because stock investing is not gambling. No. Hi, my name is Chisom, and today I'll be explaining what stocks really are, the different types, and where they are traded in the simplest way possible. And if you skip this step, you'll be investing blindly. And if you do watch this video, you'll be investing with confidence. Now, imagine a company is worth 10 million naira, and this company divides itself into about 10,000 equal parts. Buying a stock in that company means you own a little of that company, like I've explained in my previous video. Just refreshing. And basically, when you buy a stock, you're actually saying, I believe this company is going to make profit in the future. I believe this company is going to grow in the future. That's basically what buying stock really means. It means you believe in this company. Now, what do you actually gain from owning stocks? When you own a stock, 3 things can happen. 1 is capital appreciation. 2 is dividends. And 3 is ownership rights. Now, I'm going to explain. Now, first, capital appreciation. This is when, say, you buy a company stock at 1,000 naira and the company grows and your money is now 3,000 naira. Basically, you made profit of 2,000 naira, meaning that your capital of 1,000 naira appreciated into 3,000 naira. The second one is dividends. Some companies share profits with their investors. Say, for example, you own stocks in First Bank, and First Bank grows and makes profit, and they decide, oh, let's appreciate our investors a little, and they pay you a little portion of that profit. Most times it's either yearly or quarterly. It's passive income. It's not something you should depend on. Some companies don't pay dividends. All right, so that's just basically this passive income. So it comes, it doesn't come, it doesn't matter. Your actual capital is still appreciating. If the company appreciated, definitely your capital is appreciating. So if they pay you dividends, that's an extra bonus. And the third one is ownership rights. Now, this depends on the stock of the company. Now, you could have voting rights in the company. You may even attend shareholder meetings. That's how, depending on how big your stocks are. You may even be able to attend shareholder meetings, because definitely you've gotten to a certain point where, yeah, you should be involved. And you may be able to influence company decisions. Note, like I said, this depends on the stock. Because at that point, you're no longer just a customer, you're now a part owner. Now, we'll go into the types of stock. Now, not all stocks are the same. This is when many beginners get really confused. The first type is common stock. This is the most popular one. If you hear someone say, I bought MTN, I bought Apple, I bought Dangote Cement, that's an example of someone buying a common stock. And the features of this is that you own a part of the company, you can benefit from price growth, you may receive dividends, and also you could have voting rights. And this is what most beginners start with. Another type is preferred stocks. Now, this is more advanced, and the features is that it has a fixed dividend, which means it's very possible that you will know exactly what to expect, either quarterly, bi-yearly, or yearly. Another feature is that it's also paid before the common stockholders, like the ones who buy the common stock. It's paid before them. It usually has no voting rights, and there's less price movement. So basically, it doesn't really fluctuate as much. Preferred stocks behave more like a mix of stocks and bonds, and it is great for income-focused investors, not beginners. Now let's go into growth stocks and dividend stocks. Growth stocks are companies that reinvest profits. They focus on expansion and they really grow fast. Examples would be tech company and emerging brands, like brands that are just coming up. The pros of this is that it has a high growth potential. The cons is that it usually has no dividends and it could be very volatile. So basically, it's great for long-term investors, younger investors, and wealth growth. Now, the next one is dividend stocks. These are companies that make stable profits and they share profits regularly. Examples are banks, telecoms, consumer goods companies, etc. The pros are steady income, less volatility. The cons are slower growth, so you need to have patience if you're going to be investing in these kind of companies. And it's best for making like passive income, stability, and conservative investors. And the next part is stocks versus index stocks. We're making a separate video on this, but let me just summarize it a little, because this part confuses a lot of people. Now, you cannot buy an index stock directly. You cannot just buy an index stock. Example of this index is S&P 500, NASDAQ. To invest in an index stock, you need to buy an ETF that tracks it. So for example, you want to buy an S&P 500, what you're going to be buying is the VOO or SPY. That's what you're going to look for when you're trying to invest. Just search the stock code VOO or SPY. That's what you're going to look for. And if you're buying the NASDAQ 100, you just look for the stock code of QQQ, then you'll find it. And what this basically means is that one purchase of an index stock means you have access to like over 100 companies that you're investing in. If you don't understand this, you're going to panic. Knowing what stocks are, where they are traded, what type you're buying is going to help you avoid scam, panic selling, and also build wealth intentionally. In the next video, I'm going to show you how to choose your first stock, even if you're scared of making mistakes. So as usual, don't forget to follow me, like, share to any of your friends who you think might need this, and I'll be seeing you in the next video. Bye bye.